What is going on, investors? Welcome to my channel. This is Jason, aka the Frugal Investor. This video is going to be a deep dive analysis video of a recent cheap stock, that is Honest Company. Honest Company became public in 2020. It's a diaper company. Baby diaper products is their main products, followed by skincare products and cleaning products. It's a company founded by Jessica Alba back in 2012. They became public in 2020 recently. Mostly they sell eco-friendly products, that is products that are easily biodegradable and things like that. So this is a company that we are going to be doing a deep dive analysis today. The ticker symbol is HNST. Currently, the company, as I said, is only 1 year old. It's trading it for $9.53. When it was listed, it was trading for $23. So it's down from its all-time highs of $23 to $9.53. Most of its revenue is coming from digital sales and retail sales. Right now, digital sales constitutes about 45% to 50% of their business, and retail sales constitute the other 50%. And the biggest product selling that produce the most revenue for them are diapers and wipes, followed by skin and personal care, followed by housing and household and wellness. That is like cleaning products, like something similar to Clorox. And skin and personal care is basically natural biodegradable creams and all that kind of body stuff. Diapers and wipes is basically baby products, but they're biodegradable, eco-friendly baby wipes and products. That is one of their biggest selling products, the baby diapers and wipes. Now they have cut down a lot on the products that they used to sell. They used to sell a lot of products in the history before they became public, but they cut down a lot after the change of management. They brought in new management in 2019, which we'll talk about later. Jessica Alba has stayed there, but Brian, who was the co-founder along with Jessica Alba in 2012, actually went away, and new management started in 2019, and they took the company public in 2020, and that is what is going on right now. Now, we will talk about the management later, but let's start with, first of all, going to the income statement. Their revenue has gone up. Their revenue, which is their top line, it has gone up from 235 million in 2019 to 300 million in 2020, and their trailing 12 months revenue is 311 million dollars. Their gross profit, that is the cost of revenue, that is total revenue minus their cost of revenue, is $75 million dollars, and it's for 2019, and it's going up to $107 million dollars, almost $108 million dollars in 2020. The biggest expense for them is their selling, general and admin expenses, which has kind of gone up as their revenue has gone up. So the basic thing is basically whatever the money that they need to sell their products, do the marketing and stuff like that, it has gone up. Now, part of this selling, general and admin expenses, which is also a red flag, is they paid out a lot of money to the management. The management is only 1 year old, but they still managed to pay out $9.1 million bonus and payment that they added into the selling, general and admin expenses. That is after the company went public. Now, management generally, they are paid out when they reach certain goals. They increase the revenue for over 4 years or 5 years. Now, they paid out this $9.1 million bonus to the management, which is kind of a red flag, and which is also not a good thing, that they just joined the company and they just took it public, and for that they get basically free money, $9.1 million. Not only that, they have also been liquidating the shareholders, which we'll also talk about in a bit. But this $9.1 million bonus payment is what was added to their selling and general expense in 2020, and which is why their selling and general expenses are so high. That is their major expense. Now, their operating income is negative. That is, the company is not producing any income from their operating expenses. Also, their earnings from continuing operations is also negative. Their net income is, the company is losing money. The company is not profitable yet. Now, of course, the company is losing less money as compared to 2019. This year they're losing, this past year they lost 14 million, while in 2019 they lost 31 million. So of course it's progressing towards becoming a profitable company, but it is not yet profitable, and it has not been profitable over the past 11 years. It was founded in 2012, and till now the company has not been profitable. They faced a big lawsuit because of their diaper product, which was a, they mentioned it as eco-friendly back in 2014, and it was not eco-friendly. They faced a lawsuit in 2014, and they lost a lot of money with that. So the company is not yet profitable. Also, if we look at the basics earnings per share, diluted earning per share, so they are losing money. Also, if you look right here, um, share outstanding, so they are diluting their shares outstanding in 2019 was 33.9 million, while in 2020 was 34.1 million. And we will look at the shares outstanding for this year as well, 2021. Shares outstanding in 2021 is almost 68 million shares outstanding, so they are diluting shareholders left and right. They're killing the shareholders basically. Now it's a growing company, so they need capital to grow, they need capital to finance their everyday activities. But this much dilution is just mind-boggling. Also, so share dilution, 9.1 million paid out to the management. So these are all red flags that we have seen so far. Also, the company is not yet profitable, as we saw on the bottom line. Looking at the balance sheet, we can see that the company has cash on hand, which is 85 million in 2019 and 63 million in 2020. If we look at the amount of cash that the company has currently in 2021, this is the 10Q for the current period of 2021. The amount of cash that the company has is 41 million dollars that they have on hand. Also, their assets have been going up, so which is a good thing. Their current assets are $173 million, which is their liquid assets that if they want to liquidate, they can liquidate it within 1 year, which is $173 million. They are going up, so that is a good thing. Their total assets have gone up. Their liabilities have also gone up, okay, along with the assets. So that is a negative. So current overall liabilities are $101 million, while the current assets are total assets are 200, total current asset is 173 million, while their total liabilities are 101 million. Their stockholder equity has been going down. Stockholder activity is basically total assets minus total liabilities. It's good if it's going up over time, because that generates that the difference between the assets are, because the assets are going up and the liabilities are kind of coming down, their debt is coming down. So it's a small business, growing business. So not generally expecting it, but it's a good thing if it has that. So total equity has been going down. Also, their book value. So their tangible book value, which is the total amount of assets that they have per shareholder. So let's say a company which is like a steel company, let's say AU Mittal, which is a steel company. Let's say the steel company is selling for $5 a share, and tomorrow they have to liquidate the company. They have to sell everything. They have to sell the equipment. They have to sell all the cash in bank and give it to the shareholders. So the book value of that company is, let's say, $7. So every shareholder will get $7 for liquidation, while the original price that they paid for the company was $5. That's a profit of $2. So that's the book value of the company. What can you liquidate it tomorrow for and give it to the shareholders? So this company, it has a negative book value of $240. So if they liquidate the company tomorrow, the shareholders will be losing $240. They won't be getting any money. So they don't have any book value at all. Per share, they have a book value of $6.95. And so this is a negative book value. While if you look at their liabilities, they have total liabilities of $97 million. So $41 million in cash and then $97 million in total liabilities. It is not enough to cover for covering their liabilities. So the amount of cash they have on hand is less than what they can pay for their debt if they have an emergency situation. Now, now all debt is not bad debt. So some of the debt is bad, like bank debt and corporate debt and something like, variable interest debt. That is bad debt. But they have $41 million on hand, which is not enough to cover their 1 year of operations. It is not enough to cover their short-term variable rate debt. So that is a negative point as well. So some of the negative points that we have seen are the company is not yet profitable. They're diluting their shareholders at a massive, massive rate, as you can see right here. Went from 31 to 34 to 68 million shares active in the market. They're paying $9.1 million to the CEO and the executive team for no damn reason at all from the shareholders' pocket. The people that hold their shares, they're paying from their pockets to the executive team. The company is losing money. They have been losing money for over 11 years now, and they're still losing money. Okay, now the baby products, these diapers and these products, they're very competitive companies. Okay, not that this company has a specific mode that they can be profitable in the future. There is no guarantee that honest company will be profitable in the future, because this is such a very competitive space. They have no moat around them. There are 100 other companies that are selling the same products. If I do a Google search, Honest Company is not even in the top 10 diaper companies that I find, and that is on multiple web pages that I go and look at. It's somewhere it's seventh, somewhere it's 10th, somewhere it's ninth. It's not even the top 10 company that sells eco-friendly diaper products. So there's a lot of competition in this space. Amazon in this is in this space. So So it's a very hard space to find, and the margins are really low because there's so much competition. The competitor can basically reduce their prices by the whiff, and the other competitors, they don't have no choice but to reduce their prices. So the margins are very low. This is a very competitive business. There are already so much competition, there are already so many other people doing this same business, and honest company is in that business, and they are not profitable yet, and I don't know when they will be profitable, because in this business that they are in, it's so competitive. It's very hard to break a buck because the profit margins are so low and the competition is fierce. There are 10 other people doing the same thing on the same block that you are selling the same product, and they've been doing it longer than you, and they have better product than you. So it's very hard for me to see the future earnings of this company, to see even that this company will be profitable in the next 5 years or 6 years. It's very hard to see that. Now it might happen by some miracle that they come out with some product or something like that, or their beauty care products, which is their skincare products, actually grow bigger than their diaper products, and they become a bigger section and they start making more profit, which has been happening recently. Their skin and personal care has seen more better growth than the diaper products. The diaper products sale have actually gone down, while the skin and the personal care products, they have actually gone up. The sale for those products have actually gone up. So it is possible that the skincare becomes their major revenue force and they make the company profitable, but that is far way into the future. That is far way into the future. Okay, if we look at their net earnings, if we look at their let's say the book value, the company doesn't even deserve to be a penny stock, in my opinion. If you look at their net earnings, they're losing money. How can I come up with the appraisal? Let's say, for example, there's a company that's making $1 per share in profits, and then its book value is $1 per share. It's very easy to come up with the appraisal value. You just multiply $1 by 10, P by E of 10, let's say, and you come up with $10. The price of the stock is $10 plus $1 per share of the book value. So you add that, so $11. So the right price for that stock is $11. For honest company, how can you come up with a price? How can I justify paying a price of $9.53 for this company, $9.48 for this company, when it's not yet profitable? They don't have any earnings. They don't have any book value. The book value is negative. They have so much debt. They're paying out $9 million to the executives for doing nothing, for just taking the company public. Okay, that is crazy. So how can I come up with a price? How can I come up with a future number that is justified for me to pay for this company? So those are my questions for this company. It is a small cap company, $859 million market cap. Now, when it started, it was at over 1.5 billion when it became public, but now it's come down to 859 million. So it is a very small company. Growth is possible maybe 10 years from now, 15 years from now. I don't have that time. I don't want to put my capital into a company that will be barely profitable. This is a loser, in my opinion. This company is not a buy because they don't have any net income. They don't have any future prospects. They have so much competition, so low profit margins in the space they are competing in. They're diluting their shareholders rapidly every day. They're paying out $9 million to the executive team just for taking the company public. If we look at the insider activity, the people who are beneficial owners of this company, they have been dumping shares by a lot. The shared Abacus, which was a beneficial owner, 10% owner of the company, Lightspeed Venture Partners, which are 10% owner of the company, they have been selling their shares. Danke Scott Arnold, which is a director of the company, Jeremy Liu. Now, Jeremy Liu has been selling shares. Jeremy Liu is actually a director in the company. Jeremy Liu, who's Jeremy Liu? That's interesting. So these people, they have been dumping their shares left and right. Okay, so they are selling their shares, so I don't think this is a great company to buy. While the executives are dumping, the investors are dumping their shares, so this is a dud. This company is a dud, in my opinion. So that is my honest opinion on honest company. This is a very competitive space, very low profit margins, company is not yet profitable, the executives are getting paid outs, the company is diluting its shareholders. There is nothing much further to look ahead. This company is a loser, and that is my honest opinion on a honest company. If you like this type of video, please don't forget to like and subscribe to the channel. Thank you for watching. This is the Frugal Investor signing out.